It's a special edition of Business Incorporated. Thank you for joining us. I'm Chimeze Obi Iwag. Well, this week is the week of monetary policy decisions for central banks in some of sub-Saharan Africa's biggest economies, and it is expected that they may be more concerned about the impact of a potential third wave of coronavirus infections and a slow rollout of vaccines than quickening inflation, leaving borrowing costs unchanged for now. Well, most economic analysts believe that monetary policy committees in Ghana, Nigeria, South Africa, Kenya, and Angola are unlikely to follow those in Brazil, Turkey, Mozambique, Zambia, and Zimbabwe just yet when they announce their decisions on interest rates this week. Well, the Monetary Policy Committee of the Central Bank of Nigeria has been deliberating monetary policy direction for the next 2 months, with the Central Bank Governor Godwin Emefiele set to announce its decision shortly. But first, let's look at the markets. And here on the African continent, major markets we track were all in the red territory at intraday. Ahead of the MPC decision, the Nigerian main index was marginally low by 0.03%, reversing the positive trend recorded on Monday. In South Africa, the JSE index declined 0.33%. Elsewhere, the EGX30 in Egypt shaved off 1.67% at intraday, while Kenya closed positive on Monday. In Europe, stocks retreated in early trade as concerns over a third wave of COVID infections in the region rattle investor sentiment. Well, Chelsea joins us now to give us a quick wrap-up of activities in the European space today. Hello, Chelsea. Good afternoon. So, how are stocks traded in Frankfurt today after Germany announced it will tighten coronavirus restrictions?
Well, stock trading did get off to a bit of a rough start here in Frankfurt and really across Europe. The DAX here started down about 0.5%. It has recovered a little bit, but the third wave is really in focus now here in Europe. Yesterday, as you mentioned, Germany decided to extend its current lockdown for 4 weeks, but also said it would put the country into a hard lockdown over the Easter period. So for many businesses, especially those restaurants, bars, retail stores, and travel industry businesses, this is a major blow. It's already expected to shave about 1 percentage point off of German growth. And of course, we're seeing these virus concerns playing out across Europe and in other parts of the world, as you mentioned as well. But this is a major concern. The other thing that's really going to be in focus today is monetary policy out of the U.S. Jerome Powell, the head of the Federal Reserve, is expected to give his update on the U.S. economy. So that's also a major topic for markets today.
All right, thank you, Chelsea. We'll leave it at that. Well, Nigeria as well is monitoring its monetary policy committee today, and the central bank, of course, is scheduled to announce the decision in a short while. We'll talk to you again tomorrow, Chelsea. And since the COVID-19 pandemic, the unemployment in the UK has fallen for the first time despite the toughest lockdown measures since the first wave spread a year ago. And how are the markets reading those numbers? Let's bring in Juliana for intraday market wrap-up there. Hello, Juliana. Good afternoon. Well, unemployment down for the first time since the pandemic. How are the markets reading those data, and what is the general sentiment in the market today?
General sentiment is red, I'm afraid. Red. That's the colour of the markets here in London. The all-share is down at intraday by 0.33%. FTSE 100 also down by 0.31%. And the FTSE 250, the domestic market, that's down by 0.46%. In the currencies market, the British pound also down on the US dollar by 0.09%, down on the euro by 0.39%, and down on the Japanese yen by a massive 1.17%. It's all about that third wave, even though more than 50% of the British adult public have had a vaccination. You know, history tells us that it is heading this way. The Prime Minister's made that clear, which is why all of the travel and tourism stocks are doing pretty badly on the all-share today. You mentioned the unemployment figures, are pretty much a surprise, took everybody by surprise this morning, showing that it actually dropped from 5.1% in the 3 months to December to 5% in the 3 months to January. It does finally feel feel as if all the worst case scenarios could potentially be over because of the government support schemes, but we'll have to wait and see because we know that they are going to be relaxed as soon as these restrictions start getting lifted, Chimi.
Well, I'm sure the markets are still digesting those data there. All right, we'll leave it at that. Juliana, will talk to you again tomorrow. And here are some of the expectations from central banks in some sub-Saharan African countries this week. The Reserve Bank of South Africa is expected to hold the key rate for a fourth meeting when they meet on Thursday this week, even as fuel and electricity price increases due in April are set to push inflation closer to the midpoint of its target range. Well, analysts say concerns about inflation will probably mean the five-member panel will vote unanimously for an unchanged stance after their preferences were split between cutting and holding at the last three meetings. For them, the MPC could take advantage of the accommodative global environment to maximize the stimulation that it can give the economy via low interest rates. The panel is likely to remain tolerant of negative real rates for as long as the rand is relatively stable and will be wary to tighten preemptively amid recessionary conditions. Okay, let's look at the Monetary Policy Committee in East Africa's biggest economy, and that's Kenya. They'll be meeting on Monday next week, March 29. They are expected to keep the benchmark rate steady for a seventh meeting in a row amid fears of a third wave of COVID-19 infections. Analysts say while inflation at a 10-month high is a concern, it's unlikely to result in an immediate increase in the key rate. The policy stance, according to them, will be guided by macroeconomic conditions and the impact of virus control measures. Okay, let's look at Angola now. The policy makers are also meeting on Monday, that's March 29, and they are likely to hold the key rate even as the country contends with inflation at a three-year high. That's because a lot of the price pressures are seen as imported, and the pass-through from the central bank rate to inflation and consumer demand in Africa's second biggest oil producer is weak. Now, instead of using monetary policy, the central bank attempts to temper price growth by adjusting the amount of kwanza in circulation and keeps that in line with inflation targets. The governor of the central bank said after the central bank kept the benchmark unchanged in January that maintaining the key rates gives ongoing and new credit operations granted by commercial banks a higher chance of success. And let's look at Ghana there. Of course, the MPC met yesterday and held its benchmark interest rate for a sixth consecutive meeting as expected, and as it monitors the impact of new tax measures on inflation. Now, the Monetary Policy Committee held the rate at 14.5%. Inflation in the West African nation has been above the central bank's target range of 6% to 10% for most of the past year as food prices surged due to supply constraints caused by restrictions to curb the spread of the coronavirus. The Bank of Ghana expects the rate of price growth to be back in target in the second quarter of this year. Okay, let's come back here to Nigeria. Of course, the MPC started its meeting yesterday, and the decision will be announced shortly. It is expected that the committee, just like most central banks in sub-Saharan Africa, wouldn't be in a rush to raise interest rates, but we will see about that. Let's get a sense of what the committee did at its past meetings. Edidiong Ewan will tell us. Hello, Eddie.
Hi, Jimmy. Well, in January, the last meeting that the MPC had, all rates, all parameters were left unchanged. The MPR was retained at 11.5%. Now, last year, that was reduced about 2 times. We saw a reduction in the MPR 2 times last year. The retained asymmetric corridor at plus 100 and minus 700 basis points in January, but then that was also adjusted last year. We would recall that 2020 was a corona year, as people would say. So it hit financial markets, it hit economies, and so they did some of that just to reduce the impact of the virus in Nigeria. CRR was retained at 25.5% at the last meeting in January, while liquidity ratio was retained at 30%. Now, between January and now, we've seen inflation reports for February and January. In February, inflation jumped to 17.33%. Now, despite the reopening of the borders, we didn't see much impact as food prices were still higher. In January, inflation was at 16.47%. Some good news, Nigeria exited the recession that we entered last year as GDP grew by 0.11% in the fourth quarter of 2020. As at 18th of March, the external reserves were at the lowest in 10 months at $34.41 billion. And, well, some good news as well. There's been COVID-19 vaccinations ongoing across the country. We've seen people getting the jabs. You still have people who are skeptical about that. But also on the back of that, we've seen the cases of COVID related infections drop. I think yesterday we had 139 cases or thereabouts. So the second wave has come and it's going. Hopefully we do not experience a third wave like Kenya is experiencing now. But then these are some of the things the CBN will have to consider. I know that in one of the interventions that they put in place last year, which was the one-year extension of moratorium rate, which was supposed to expire on the 1st of March, that was also extended by 1 more year. So that's going to be expiring next year. So there's still a few things that the CBN is doing, but these are the major things that they should be looking at. I know in trying to boost remittances from the diaspora, the CBN introduced the Naira for Dollar scheme where you get 5 Naira for every $1 that was sent to you. I think we've seen a lot of people doing that. Chimi, I don't know if you told anyone to send you some dollars, but I've benefited from that.
I wish I've got someone to send me some dollar.
But the CBN has been, trying to do all these things. A lot of analysts expect the CBN to hold rates, just like we've seen some of the other banks do, and then there are expectations from other central banks across the continent to do the same. So we'll see how that goes. However, there are some people who believe that with inflation at 17.33%, they're thinking that maybe the CBN should tinker with the rates. We don't know how that's going to play out. I mean, we're all here watching and counting
that's the
down.
dilemma. That's the dilemma the central bank has found itself, whether to chase inflation targeting or the economy, stimulating the economy. Of course, we've seen that inflation rate galloping 17.33%. But then we have unemployment rising, the fragile economic growth. So that leaves, the central bank, in
a tight spot.
Exactly. Not knowing exactly what to do. But we will see what eventually they turn out to do. But I guess a lot of people believe that just for the central bank to still stimulate the economy, as we've seen the GDP growth, growing. We've come out of the recession, but that's a fragile growth there. So the consensus is that the central bank might probably would want to hold the rate as it is, but we can only just wait and see. It's just in a few minutes from now, the central bank will, of course, be announcing that rate. All right, Eddie, I guess you're done with your analysis. Okay, let's take a break. And when we come back, of course, we would have to talk to our guests on what is expected. To stay with us. All right, still looking at the Monetary Policy Committee's meeting, expected decision. All right, let's bring in Paul Alaje, the lead economist and enterprise partner at SPN Professional. Thank you very much, Mr. Alaje, for joining us on the program.
Yeah, thank you so very much for having me.
Now, since the last MPC, we've seen more countries in Africa, including Nigeria, roll out vaccines, even though at a slower pace. However, there are still concerns about the impact of a potential third wave of coronavirus infections globally. How significant is this for economic recovery, and how do you see this shaping the decisions of the MPC this time?
Well, I think this will help MPC to make decision whether to relax or to tighten or to sit on the fence. Recall that Nigeria now has, even though very low when it comes to what has happened in Europe, when you compare the number of vaccines and you compare that with the total number of population. But I strongly believe that as Nigerian authority continue to expect more vaccine to come into the country, and the rollout plan of vaccine, I believe we would increase. This will give positive signal and hope for monetary authority as to the expectation of how the economy activity will be in future. Also note that this is not just about what is happening in Nigeria, but more importantly, what is happening around the world, because the commodity that has largest impact on exchange rate in Nigeria and also on the economic activity in terms of revenue of government remains the crude oil. And Nigeria, even though we export, we cannot sell to ourselves because of a non-functional refinery as we have them today. So we have to export and also buy from the world for us to have PMS in our vehicle operations, generators, plants, etc., etc. So the more vaccines we have around the world, the more the business confidence we have, which will bring about stability. It will have impact on growth. Recall that Nigeria had narrowly escaped recession. We are now at 0.11%. Apart from that, we've seen inflation as it continues to grow because I believe this will be one of the considerations of monetary authorities today. We have also seen what is happening to unemployment according to a new report published by the National Bureau of Statistics. So what I'm expecting is vaccine on one hand is sending positive signal, is sending signal of hope, but the mention of third wave is also a huge concern. What that means is we have to make decision cautiously.
Now, still looking at the external front, there is the recent $1.9 trillion COVID-19 relief bill signed by the U.S. president. And of course, last week, the Fed signaled it's not going to raise rates until 2023. Now, these are supposed to have some kind of spillover effect on commodity prices like oil. So how do you think this, again, will influence this decision?
Okay, so first of all, to say what I expect from MPC today, I don't expect an increase, even though that analysis before our organization came up with that position of what we expect monetary policy to do. We have considered several factors because if you increase now, unlike what the rest of the world is doing by keeping rate intact, most economies are just trying to have a U-shape. We are at that turning point, like Nigeria experienced it in the Q4, as announced by National Bureau of Statistics. It is still very, very fragile. So what is wise for most economies to do is perhaps to keep rates intact, even though there are other analyses around that, but because of the question right now, we need to keep rate intact. But you see, we have other concerns. Population is being vaccinated, the vaccination is going on, but we need to also do that with speed so that the third wave will not be here before we start the massive rollout of COVID. So I am seeing in the near future, talk about 3 months, 6 months down the line, a relatively balanced economy compared to the fragile economy that we are operating right now. And this will send even more positive signal to Monetary Policy Committee as to what the rate should be. I'm not seeing major adjustment, particularly in MPR. I still expect it to remain at 11.5%, and that will have implication on what banks will give to attract more people to save so that we can have higher investment, because savings, fixed deposits, and all of those will send signal. Also for government ability to access funds through T-bills and bonds, it will also have tremendous impact on all of those. This will also affect our foreign investment, even though it might not be directly related, because when rates goes high, it is expected that we are going to have more in terms of attraction to the economy. But should we sacrifice that for the growth that is fragile? I think Monetary Authority will go for growth. The central bank governor, in about 3 announcements of MPC, had said right now Monetary Authority needs to help fiscal authority in terms of achieving growth goal for Nigeria. And you recall that from minus 6.4% to minus 3.64%, now to 0.11%. What all Nigeria needs is positive growth to be sustained, and for Nigeria perhaps to meet up with population growth than before we start having that. So America and so many other central bankers around the world have sustained their market because of high level of uncertainty. Inflation is although at 17.5%, but when you look at the key cause of inflation, when you break down what is driving inflation, one of the major components, it is not monetary driven. It is in fact food driven. We call it food inflation. And food inflation is increasing because of high level of insecurity. So if we can fix security to a reasonable extent and we have more and more people go to farm, I'm happy that government have relaxed the border closure policy. So we're expecting that even the rate of growth of food inflation should we reduce by now, which we'll start seeing, I think from by the end of this quarter, this month, we'll start seeing a significant reduction in food inflation, even though inflation may still go high, but the major driver of this increase in inflation will start to reduce. But more importantly, for us to see significant reduction, either in inflation or food inflation, we need to secure the population. We need to secure the farms. We also need to provide reasonable security and logistics, because these are two major factors driving inflation, apart from other monetary factors.
All right, Mr. Alaje, a quick one before we end this segment of the conversation. On a broader scale, how do you see most African countries navigating this challenging time, especially given their vulnerability with volatile commodities, the COVID-19 resurgence, and of course the slow vaccine rollout?
Okay, so I want most African countries to subject the vaccines to further rigorous tests. If they can confirm that it is safe for human, I think they should vaccinate the entire population, maybe to have herd immunity. Talk about 50, 60, 70%. What that means is production will continue. As production continues, that is what we bring most of the economies out of the current economic quagmire. So if they are able to get that, you start also seeing reduction in inflation, and at the same time, unemployment. So when they can do that, we start seeing jobs will be created. We start seeing African countries will experience what they had before COVID. But before vaccine, if third wave comes, even though we are producing locally and people say it's not affecting Africa the way it affected the rest of the world, the truth is, so long as Africa still needs to do business with the rest of the world, when demand reduces, it will have implication on supply, because even if you produce everything and nobody is buying, or you are not buying sufficiently enough, it's going to affect your revenue. This is how COVID for Africa is more economic danger than health danger for Africa, because when you put together the impact of COVID in Africa compared to economic impact, certainly economic impact outweighs the health impact. But of course, what should Africa do is to see how to get the population, particularly about 50 to 70% of the population, how to get vaccines, and check which of the organizations producing vaccines today have the safest, have the best that is good for Africa. So if they can do this, they also need to partner with some other organization. I understand some organizations are already giving reliefs in terms of debt repayment and so on and so forth. I also want more and more of those to get to Africa. So also to quickly see how African Continental Free Trade Area ratification, what has been ratified, Africa should start doing business, intertrade within African continent. This could also boost trade and economy within the continent. More importantly, is to provide relief support. When you look at what central bank has done in the last 1 year within Nigeria, for instance, by providing several relief, name it, targeting production, etc., particularly from pharmaceuticals, small-scale businesses, schools, etc., etc. If we can repeat this for the rest of Africa, because this is a dangerous moment. You saw what the American president signed, about $1.9 trillion. That's over $1 trillion. That's a lot of money. Even though Africa may not be able to sign that much, but what we can sign to support the local business, the small-scale businesses, to give them that support which they need now, so that we don't lose them before we get back to economic recovery.
All right.
I think it would be a good way to go for most African countries.
Thank you very much, Mr. Paul Alaji. Well, in about 16, 17 minutes from now, the Central Bank Governor, of course, will be announcing the policy decision. Thank you very much, Mr. Alaji, for being on the show. Okay, that's a wrap on Busy Special for today, and I'm Chimeze Obi Iwagu.